All right, so welcome to Learning Objective 5. Learning Objective 5 kind of goes back to the issue of manufacturing overhead. Now remember, manufacturing overhead was allocated through the predetermined overhead rate. It was based on estimates at the beginning of the year. Okay. Well, what do they do at the end of the year, or end of the period? Right. In this case, it's the end of the month of January. Well, we have to really kind of make sure that whatever it is that we applied, which is what we assumed our cost would be, compares well to the actual cost. Because after the period is done, we can actually go back and calculate the real cost. Remember, predetermined overhead rate allows us to allocate based on an estimate that we do at the beginning of the year. But at the end of the year, end of a period, we can go back and check how good our estimate was. Okay. And so we're looking at the difference between what we have assumed, which is the applied, versus how much it actually cost us in overhead. So this particular objective looks at distinguishing between the two and seeing how we did. How do we do? Well, we either under-applied or over-applied the overhead. And I'll explain that in a moment. All right. So here, by the way, if you're in the book, we're on page 66 and 67. All right. So in this case, we had, I'll go back to the statement. Cost of good manufactured schedules show manufacturing overhead applied was $22,400. And remember, the manufacturing overhead is added to direct materials and direct labor to get the total costs. Okay. So we're okay on direct materials. We know that happened for sure. We're okay on direct labor. We know that happened for sure. We don't have to estimate those. We just know. Manufacturing overhead is a little bit different. And so we're really kind of looking at how did we do? Did we really estimate well, or were we off? Okay. Because that's ultimately going to be on our income statement. Cost of good manufacture is part of our income statement, which means it's going to have, it's an expense. It's cost of goods sold. And thus it's going to affect our gross profit and our net income. So we have to make sure, as you know, financial statements have to be as accurate as possible. So we have to go back and check to see whether what we estimated and what actually happened was good. And if it's not good, how do we deal with it? Okay. Well, we basically compare, and I'm down here at illustration 219. We compare what was actually assigned to what actually happened. Okay. So when you compare what's actually been assigned, which happened early, compared to what we actually spent in manufacturing overhead, we're going to see that manufacturing overhead will have some type of balance left over. The balance means that if we actually, if you look at actual costs being bigger than applied costs, then a debit balance in manufacturing means that we didn't apply as much, right? We actually had a lot more costs incurred than we actually assigned. So our manufacturing overhead is smaller, which means our costs look smaller, which means our profit looks bigger. And so when we under apply manufacturing, because the actual cost is bigger than what we assigned, it creates trouble because, again, our costs are wrong. They look lower. Our profit is wrong. It looks higher. So we have to take care of that debit balance in manufacturing overhead. But what if the opposite occurred? What if we thought we were going to spend a lot more than we actually did? Well, then there would be a credit balance left in manufacturing overhead. And that means that our overhead was overapplied, which means we actually subtracted out more costs than we actually incurred, which means that our costs are bigger than they need to be, and our profit is smaller than it needs to be. And that basically is the under and over for manufacturing overhead here. So what do we do at the end of the year? Well, we simply have to adjust, okay? We move the balance to cost of goods sold, okay? We move the balance to cost of goods sold because ultimately the manufacturing overhead and total manufacturing costs are going to show up in cost of goods sold. So when we do have to adjust this account at the end of the year or at the end of the period, we simply adjust it to cost of goods sold. That's what the COGS is here, cost of goods sold, okay? Because we really want our manufacturing overhead account at the end of that period of time to be zero. If we've allocated everything, we want it to be zero. But when you compare, sometimes it doesn't work that way. So here's the illustration, and this is just a basic one. Wallace Company ends up with a credit balance in manufacturing overhead. So let's go back to the previous slide. A credit balance in manufacturing overhead means, in this case, that the overhead was over-applied. Means we thought we had more overhead than we actually did. So we subtracted more out of our costs than we actually had for costs. So our cost of goods sold is higher and our gross profit is lower because it's that credit balance means that we made that mistake. So we fix it in this way. The adjusting entry to fix the overhead would be to debit the overhead account to bring the account to zero. Remember, it's got a $2,500 credit balance. How do you bring this to zero? Well, with the debit of $2,500, then the account's balanced. A zero balance means the debit and credit side is equal. Okay, so if you have 10,000 in debits and 10,000 in credits, the balance is zero because your debit and credit side is equal. So if you have 2,500 in a credit balance and overhead, and you debit that 2,500, your balance will be zero. You move that credit to cost of goods sold because you want to lower your costs. Okay, having a credit balance means you over-applied the overhead, which means you thought your costs were higher than they were. So you have to lower your costs. So lowering your costs of goods sold happens on the credit side. And that's what happened here. This is your do it exercise for objective 5. It's on page 67 if you have your book with you. And we're looking at a car company, unless if I was back in Boston, I'm originally from Massachusetts, I'd be talking totally different to you right now. I'd be saying this is car company, car. You got a car? What type of car do you have? Would you park your car? Okay. So for car company, doing pretty good, right? There's a predetermined overhead rate of 140% of direct labor costs. It's pretty high. Okay. So during this particular month, car incurred $90,000 of factory labor. $80,000 is direct. Now that's important 10,000 is indirect, because the predetermined overhead rate is 140% of direct labor. Am I being too direct? So we're actually looking at the overhead is going to be applied to direct labor, not indirect labor. So this $80,000 becomes really important. The actual overhead that we incurred, that actually happened, was 119,000. So let's compute what we applied, and we can compare that to what was incurred. So what actually happened, okay, the applied piece. I'm sorry, what we were expecting to happen, was that we would have $80,000 of direct labor, and 140% of that would be allocated as manufacturing overhead, which means that 112,000 was what we were expecting to apply. Okay, that's what we were expecting to do. What actually happened was 119,000, right? In other words, we underestimated our costs, our manufacturing overhead. We thought we were only going to allocate 112,000. We actually ended up incurring 119,000. We were $7,000 off. Our costs were $7,000 less than what they should be. So then what we've done is we under-applied cost by 7,000. Right? We were low. We should have applied 119,000 of cost. We only applied 112,000 was our estimate. We're 7,000 short. That's the under-apply. Okay, we're 7,000 short. Okay, and that is